Good evening, this is Ken at Tortoise Capital. This is the daily debriefing for January 22nd, 2019. We're looking at some case studies in the ETF DIA, the Dow Jones 30 Industrials. These case studies in today's intraday trading was supported by the weekend multi-time frame analysis, what we're calling MTFA, that we did over the weekend, published that hour-long video last night on how to do it, which left us with a particular set of trade frames that helped guide our decision making today. That technique is fully disclosed and covered in detail in our home study swing course, which is on sale through the end of January 2019. So just contact me if you're interested. You may recall, or not, what we did is essentially apply a multiple time frame analysis checklist where we go through monthly all the way down through the 30-minute time frames, and then we apply in sequence each of these lenses: the MACD 4 seasons, pinch and stretch technique, regression line crossover techniques, regression line fractal frameworks, finish it off with some support and resistance, and then from this we build an integrated decision-making support system that helps guide our trading intraday and through swing trading. Update this on the weekend. The monthly and the weeklies don't change that much, and so you have this constant narrative for the market, for your sectors, for your targets, that helps make your decision-making systematic, disciplined, and relaxed. All right, so when we applied that technique, you will recall, we ended up with a series of yellow zones. These are areas in which, during the look-back period, we're within that trading range. So going into today, this was Friday's daily yellow zone, and then we have indications to go long or short once it breaks out of that trading range. The weekly corresponds to this little darker yellow region, and then the monthly to this region. Now, each of these red lines and green lines ends up being support and resistances that we identified during the details of our analysis. Each one of those is an area in which we have a reason to believe that price could make a sudden move in either direction, either to find support and reverse, or to crash through and collapse, and the same thing to the upside. So we identified all those in a systematic way. Then when the market opened, we started shifting to our regular trade. When we started the day, what we had was a lot of sideways chop. There wasn't much to pick from. I had some things to do in the morning, but by this time at 11:30 to 11:45, there's a Z3 pinch had developed, in which we have abnormally sideways and compressed behavior. You notice the Z3 lines here have pinched when price crossed the 270 regression line and broke out of that even tighter pinch box. That's our signal to go short. After a decisive move downward, took a second short position. In about 1 bar as I was making this chart, it reversed, and so we essentially had a micro loss on the second one and cashed the winning position there, about 50 cents on the contract. And notice that we had this long, narrow Red River and the 4 seasons giving us nothing, but this was the breakout into what was going to be a significant winter move. The next thing that happened was there was no follow-through. Price couldn't even get through the dragon. The RL10 rolled over. That creates the pocket. Our automatic short not later than time would be a violation of the RL10. That'd be a collapsing dragon over in here. But we elect to get short in the pocket as the 10 rolled over. An immediate another collapse, and so it took a quick second position and moved our stop down to lock in the gains and make sure that we get paid. We had just entered the spring at that point, but it's starting to roll over again. Those two trades paid off very well. That would have been this this trade in here that I'm sorry, this trade in here that you see, and this is the larger trade frame. This is the start of the day. That was yesterday's price action, and the day before. So just in a little bit of a wider context, two efforts to get short, quick win, and then an immediate reversal, and then reestablishing. Now we're looking for a runaway move down to 243, at which point, if it breaks through, we would add a third position. As you can see, there actually was some play available earlier, and so you don't have to get them all. Later in the day, after that sell occurred, we ended up getting another sideways quiet channel developing inside here. This was that pre-planned support level you saw from the previous chart. This was one where I played the Z3P long. The breakout of the Z3 lines and beginning to expand. It had just crossed above the 0 line, so this looked like an opportunity to get back to the VWAP. There was no follow-through when we got the RLXD crossing through the 10, stopped and reversed, and that was essentially a pocket entry. The next entry was just as we're getting a collapsing dragon. If you trace back to the RL10, when that breaks, that's a sign of a big collapse. And notice how when you get those collapses, it's sudden and sharp, which is why I like to enter in the indecision zone. Not as certain, but you get a better fill. And now when it's running away, you have an opportunity to lock in the move. After this couple bar hesitation, and broke down again a 1, 2, 3, put the third position on. I thought about a fourth position, but we were around at lunchtime, and I didn't manage that one very well. It continued all the way down, found support. At this time, the PSAR, which had been our guide, caught up with us, so you had this 1 slowdown, 2 slowdown, 3 slowdowns, and reversal. That looked like that was a nice 1, 2, and crossing the upper skin of the dragon, hit the PSAR, seemed like a natural spot. And winter had become spring and was advanced into the Red River, started to move out, and this actually became an owl entry because we had to wait for the RL30 to hook up and the dragon to hook up. So we got a reasonable entry on the owl with a stop below the dragon. That would have been a stop and reverse because I'm playing this as a pocket. As long as it took for this to go, and it still hasn't moved out. It hasn't failed further, but it hasn't followed through. This is looking like a pocket developing in here, and so I'm already prepared to get short at 240, 285, not later than with a collapsing dragon here. That owl ended up paying off for us. And we'll see that. Actually, I should really show this one. Yeah, so here was that owl. It paid off, not much, but then we get the, it rolled over when we get an owl the other way, and that was in line with the primary trend of the day. So we got this short, and then a crossing back into the spring and departing the Red River and approaching summer. It seemed like a reasonable place to lock in that gain. Yeah, so what I want to show now is that by dialing out now to the 30 minutes, I want to put that intraday move into context. This is where everything crossed the RL270. You see the RL270 coming down, and then everything crosses north. The 10, the 30, the VWAP, everything crosses north, and that remains the play all the way out here until today. And that price action was sufficient to cause the 270 to slow down, get flat, and resume. And so you got that long train running up until the extreme. So you're at the high of the month, the week, and the day, and then rolled over, and now you're starting to trip these little these wires. And on a 30-minute, we've just entered. We're getting ready to enter the winter. If we now go out to a 2-hour, that seen in a little even further back context, almost a yin-yang kind of a move. Here's where those owls happen. Pick up the monthly yellow zone here, and again the weekly, and then the daily tucked up inside here. So to me, this definitely feels like sensing that rollover, that rejection at the same place it rejected last time. We talked about this extensively in our markup video. So for subscribers, it's really worth, I think, listening to that again, going through the steps of the procedure, applying those 5 lenses to give you an integrated and deep perspective from a number of different points of view into how things are going. Yeah, so that's everything I wanted to cover on today. Maybe we can get into the daily report while we're here. All right, so let's pick up the daily report while we're here for January 22nd. Market health check. Today it rolled over at that we achieved that price target on Friday that we were looking for as a return to that resistance line. Rejected that. Still inside the upward sloping 10-period regression channel. The 30 has rolled positive. We are in the summer still. So still this is upward. We're looking for these price targets to the upside. I would say the bottom of the dragon for me is kind of the indicator of things going south, in which case we'd be looking for price to come down to about 245 down here after it penetrates the PSAR, Z1, and then down to the belly of the dragon. So still just one day of pullback in this rebounding market. I mean, all it would take, I think, for this to go would be announcing a political deal to end the shutdown in the government. So we'll see how that goes. Still bearish normal, playing them a day at a time. Risk Z is still favoring the swings, but starting to roll over a little bit. So I think the easy money, now there's no such thing as easy money, but I think the easier money is done, is pulled out of overbought conditions. We got ILF on a channeling long system. Remember, Latin America and Brazil have been the strongest. No other signals in the mechanical systems. You can see the 10-day max pain leaders, and then the min pain. These are the ones with the best relative strength. Not much to choose from on the Dow Tactical Summary. At the end of a long run, is a lot of our mechanical systems aren't really firing. Same on the ETF 30, a handful of dojis, not much to choose from. The most positive Z stretches, these are the ones that remain the highest percentage above their own Bollinger Band mean as expressed and sorted by the Z score of that stretch. So Goldman, Nike, and XLF are all doing exceptionally well. The most negative Z stretches, these are the deepest below their own Bollinger Band mean. The most expanded pinch boxes are the ones with the widest rivers. These have been the most trending over a 30-day period, and the degree to which that, on a Z score that has stretched. The most compressed pinch boxes, so there's nothing that has yet settled into a super pinch, so we will continue to stock that. So you have a handful of symbols at extremes that are worth paying attention to. Auto framer with all the usual suspects. Lots of things based, the last 2 to 3 weeks have been a strong swing. And so we still have a lot of things in spring, but mostly in summer. A few things starting to roll over already. GE and Home Depot into the fall, whereas P&G and Pfizer in the consumer staples and healthcare space still in the winter. I'd be looking at those to pile on short if the market actually does sell off, and if that, if their sector continues to suffer. Market mosaic, just the first down day in a long time, still an upward trend. Slope of the 30 just, is remaining positive. The 90 has continued to curl up, just starting to get better in here. And so there's reasons to believe, even though we're finding support at the far side of the river, if it can hold support here around 260, we'll be all right. But just notice the last two times that after sell-offs, it made strong moves, and then the far side of the river act as a boundary. So it remains to be seen what we have going on here. All right, that's everything I wanted to cover today. Keep your wrist measured and your powder dry.